Ever pondered about the potential repercussions if you'd invested $1,000 in Coinbase back in 2021? Or what if you'd opted for 2022 instead? Well, let's take a look at the figures. If you'd invested $1,000 in Coinbase in 2021, by March 2024, your investment would be worth $958. That's a 4% decrease from your initial investment. But what if you'd waited a year and invested in 2022? By March 2024, that same $1,000 investment would have ballooned to $5,160, a whopping five-fold increase. It's a stark example of how crucial timing can be when it comes to investments. But why the stark contrast between the returns from these 2 years? What happened with Coinbase's financial performance that led to such a difference? Well, that's what we're here to dissect. Understanding the financial health and business performance of a company is key to making sound investment decisions. By delving into the financials, we can gain insights into a company's revenue streams, profit margins, cash flow, and much more. This information can help us predict future performance and assess the potential risks and returns of an investment. In the case of Coinbase, we'll be looking at their revenue breakdown, profit margins, expense analysis, and asset analysis. We'll also be delving into their cash flow and conducting a DuPont analysis. This comprehensive analysis will help us understand why Coinbase's stock performed the way it did and how it might perform in the future. It'll provide insights into the company's strengths and weaknesses and help us determine whether it's a good investment. So, whether you're a seasoned investor or just starting out, join us as we dive into the financials of Coinbase and demystify the world of investments. To shed light on this, we're going to delve into Coinbase's financial performance, providing insights to help investors make informed decisions. In 2023, Coinbase's revenue stood at $3.1 billion, marking a significant decline from its 2021 peak of $7.8 billion. That's a drop of almost 60% in just 2 years, equivalent to an annual decrease of 37%. What's interesting here is the change in the structure of Coinbase's revenue. In 2023, 48% of the revenue came from transactions, 45% from subscriptions and services, and the remaining 6% from other sources. This is a stark contrast to 2021, when a whopping 87% of revenue was generated from transactions. This dramatic shift tells us a lot about the state of the cryptocurrency market. It suggests that the market took a nosedive towards the end of 2021, leading to a sharp drop in Coinbase's transaction revenue. In other words, the company's reliance on transaction revenue made it vulnerable to the volatility of the cryptocurrency market. However, it's not all doom and gloom. The rise in revenue from subscriptions and services is a positive sign. It shows that Coinbase has been able to diversify its revenue streams and reduce its dependence on transactions. This could be a smart move, as it might make the company more resilient in the face of future market downturns. Geographically, 88% of Coinbase's revenue in 2023 came from the United States, with the remaining 12% coming from other regions. This shows that the company has a strong presence in the US market, but also highlights the potential for growth in other regions. To sum it up, the story of Coinbase's revenue in 2023 is one of change and adaptation. The company has faced challenges, particularly in its transaction business, but it has also shown its ability to adapt and diversify. And while the fall in revenue is a concern, the changes in its revenue structure could be a sign of a more sustainable future. Coinbase's revenue composition has seen a notable shift, indicating the turbulence in the coin market. Coinbase's net profit margin in 2023 was 3%, a dramatic improvement over -81% in 2022. This drastic turnaround is primarily attributed to the company's strategic expense management. Let's delve a little deeper. In 2023, Coinbase's expense-to-revenue ratio comprised 3 main categories: transaction costs, accounting for 13%, technology and development costs, taking up 42%, and selling, general and administrative (SG&A) expenses, covering the remaining 45%. Now, what's interesting is that the expense-to-revenue ratio in 2023 actually decreased compared to 2022. This suggests that Coinbase has effectively implemented cost-cutting measures, a strategy that has positively impacted the company's net profit. In essence, by keeping a tight grip on their expenses, Coinbase managed to swing from a negative to a positive net profit. In raw figures, the net profit for 2023 stood at $100 million. This is a significant leap from 2022's negative $2.6 billion. However, it's important to note that it still falls short of the spectacular $3.6 billion of 2021. This improvement in net profit margin is a clear indication of Coinbase's ability to adapt and evolve in a volatile market. By focusing on improving their expense management, Coinbase has shown resilience and strategic thinking. The company's ability to turn a negative net profit margin into a positive one within a year is no small feat. In conclusion, the positive net profit in 2023 indicates Coinbase's effective cost-cutting measures. It's a testament to the company's resilience and adaptability. But as always, one must remember that past performance is not indicative of future results. It's crucial to keep an eye on the market trends and the company's strategic decisions moving forward. In 2023, Coinbase's total assets soared to $207 billion, more than double its 2022 figure of $90 billion. This significant leap in total assets is largely attributed to an increase in a particular category of assets: safeguarding customer crypto assets. Safeguarding customer crypto assets is the cryptocurrency that Coinbase holds on behalf of its users. This category of assets surged from $75 billion in 2022 to a staggering $193 billion in 2023. This tremendous growth represents a more than 150% increase in just 1 year. But why is this important? It's quite simple. The more assets Coinbase safeguards for its customers, the more transactions it can potentially facilitate. Each transaction generates fees, which contributes to Coinbase's revenue. As such, an increase in safeguarded assets signifies the potential for more transactions and, consequently, higher revenues. This growth in safeguarded assets also indicates a growing trust in Coinbase. It suggests that more and more customers are entrusting Coinbase with their cryptocurrency. This growing customer base is a vital ingredient for Coinbase's future profitability. However, it's also crucial to consider the risks associated with safeguarding customer crypto assets. Cryptocurrencies are notoriously volatile. A sudden drop in cryptocurrency prices could lead to a significant decrease in the value of these assets. Yet, Coinbase's ability to navigate these risks, as evidenced by the growth in safeguarded assets, is a testament to its robust risk management strategies. To sum up, the surge in Coinbase's total assets, fueled by the growth in safeguarded customer crypto assets, is a positive development for the company. It not only indicates potential revenue growth, but also reflects the growing trust of customers in Coinbase's services. The growth in safeguarding customer crypto assets is a positive sign, signaling potential profit growth for Coinbase. Coinbase's operating cash flow and free cash flow in 2023 were both positive, marking a significant turnaround from 2022. This is a bullish sign, indicating that the company's core operations are generating cash again. Now let's delve into our DuPont analysis for Coinbase in 2023 and see how it stacks up against 2022. The DuPont analysis breaks down return on equity, or ROE, into three components: net profit margin, asset turnover, and equity multiplier. It's a powerful tool, providing a nuanced view of a company's financial health. In 2023, Coinbase's ROE was 2%. This was a vast improvement on the negative 47% from 2022. The driving force behind this progress was the significant enhancement in Coinbase's net profit margin, which reached 3% in 2023, rebounding from a low of negative 81% the previous year. Now let's talk about asset turnover, which measures how effectively a company is using its assets to generate revenue. Coinbase's asset turnover in 2023 was 0.02, compared to 0.07 in 2022. This decrease indicates that Coinbase was less efficient in using its assets to generate revenue in 2023. The final component of our DuPont analysis is the equity multiplier, which reflects a company's financial leverage. In 2023, Coinbase's equity multiplier was 32.86, showing a considerable increase from 16.36 in 2022. This suggests that Coinbase relied more heavily on debt to finance its assets in 2023. In conclusion, while Coinbase showed significant improvements in its net profit margin and returned to profitability in 2023, it was less efficient in using its assets to generate revenue and relied heavily on debt. These are important factors to consider for potential investors. Don't forget to subscribe to our channel for the latest videos and leave a comment about the company you'd like us to analyze next.